the research team gets a lot of emails when markets start to, heat up a little bit. And we get all these people that ask about, ETFs versus stocks. So what they did was they looked at ETF performance pre and post significant events. And over the last couple of years, we've had some pretty significant events. Obviously, the pandemic, all the meme stock craze, a bunch of other things just in general, markets that sold off 30%, markets that rallied 30%, lots of different Fed news, all that kind of stuff. So what the research team decided to do was take a look pre and post kind of pandemic performance. Let's go to the next slide. So a significant event, they often disrupt the normal function in markets, can lead to sudden changes in asset prices, market volatility, risk adjustments, and trading volumes. This is one of the reasons that we're brains over bots, because we're always making certain adjustments. Because, we look at markets as nothing, like something we might do today might be different from what we might do tomorrow or the next day. So significant events can originate from various sources, such as economic things, geopolitical developments, policy changes, technological advancements like AI, or unforeseen crisis like a pandemic. All these things, change. So considering COVID-19 as a significant event, how did it influence factors like volatility, risk-return relationships, and the likelihood of profitability, especially within the realm of exchange-traded funds and various sector ETFs? Let us take a look. Next slide, please. So what the research team decided to look at was SPY, IWM, two indexes, gold, diamonds, and bond. Diamonds, DIA is the Dow, and TLT. So we looked at bonds, gold, and three different indices. We took 17 years worth of data, 45 days to expiration, managed to 21 days. We looked at 10 to 16 deltas of short strangle, and we computed lots of things. The average implied volatility, the risk adjusted ratio, which is CVAR, and then the percentage of profit. We compared the results before and after COVID. Now, the first thing you're going to say is, well, after COVID, the volatility is going to be higher.
Sure.
We should have done better.
Sure.
Before COVID, we were kind of slow. Let's see. So first thing, this table illustrates the shifts in anticipated market volatility uncertainty between the period before COVID and post-COVID, gauged through the utilization of the VIX index. A significant rise in uncertainty is projected to lead to a 32% increase in implied volatility. So the first takeaway from this segment is when there was an unforeseen event, like a pandemic or like something else that might happen in the future, it could be lots of different things, you're talking about the potential, for as much as a 32% increase in implied volatility that lasts over time. There is a high probability that assets that previously demonstrated stability might now be perceived as riskier due to the increased uncertainty and amplified price swings. So what we looked at before COVID-19, between 2006 and 2020, the VIX was about 19 on average. After COVID, it was 25. That's your 32%.
Sure.
Right?
Sure.
Simple.
Sure.
Nothing.
Yep.
This is not a complicated piece. It's just simple, but that, people want context over what it is. So what does that mean? Well, that means if you're kind of short premium in a dull market, that's kind of what you could expect the pressure to be. Like a 32% move against you.
Yeah. If you're trying to measure it, sure.
Well, people,
instead of just saying volatility increased.
Yeah, because people all the time, listen, the 32% doesn't mean anything to anybody. It doesn't mean jack. But when people ask us, they say, give me a reasonable, not a crazy, like, what if we crash tomorrow 1,000 points, but give me a reasonable worst case scenario, right?
Yep. I'd say 30%.
There you go.
Yep.
There's your number.
It's a good number, good context to have.
It's good context. Let's go next slide. So now we decided to look at those 5 ETFs, and utilizing a strangle strategy, we've examined the risk-adjusted return of the period prior and the post-COVID return as depicted in the tables below. So on average, the after COVID era, which we're still in, where we have high risk adjusted returns with an increase of about 12%. So we decided talk to me post-COVID. So we looked at a bunch of things, pre-COVID and post-COVID. Then we looked at P&L per day. We looked at CVAR, and we looked at CVAR divided by P&L. And what we found in these cases was that your P&L per day was significantly higher when volatility was higher, but your risk was greater. Just what you would think.
Right.
So your P&L, just to give you an example, in the SPY for the 14 years before COVID was 49 cents a day. After COVID, it was $1.90 a day, but your outlier risk doubled. That's the problem.
That's a problem.
Yeah, it's a problem. If you look at, just for example, TLT, which is bonds, pre-COVID, it was 17 cents a day, and your CVAR was 340. After COVID, it was $105 per day, but 213. It's a little. Bonds are probably not the best case because even though the dollar per day went up, CVAR went down, but everything else, CVAR doubled everywhere else. So the bottom line here is, you make more money, you take more risk.
That's going to happen.
You make more money, you take more risk. Let's go next slide. So as shown by the table below, the likelihood that the options trade will result in a profit for the seller increased by 1.7% as we compare time before COVID and after COVID. When selling premium, an increased POP translates to an improved likelihood of retaining an upfront payment as the profit if the option contract expires out of the money. There is not a statistically significant difference here in POP, and we've talked about this 100 different times over the last decade or so. But when you get an opportunity to make more money, you don't really get a significantly better probability of making money. You just make more money when you make money. I know it sounds. Go ahead.
I get it.
Yeah, it sounds a little weird, but that's what it is. So before COVID, you could actually see the numbers are about the same or a little higher, depending on which one it is. Like in the SPYs, they're 2% higher. In the Qs, they're 6% higher. But then in IWM, I'm sorry, not IWM, but GLD, they're 6% lower. In diamonds, they're 6% lower. In TLT, they're 6%, 7% lower. So it evens out. But the bottom line here is that it's essentially the same. POP never changes. What changes is the amount of money you can make.
Very good.
Let's go next slide. So some of the takeaways. In the aftermath of COVID-19 period, there was a notable 32% rise in market volatility. This shift encouraged traders to approach the increased market fluctuations with heightened vigilance, potentially reflecting uncertainties triggered by the pandemic and its consequences. However, despite the heightened volatility, traders engaging in options trading could find more favorable probabilities of profitable outcomes. Moreover, investments in general seem to have delivered improved returns relative to risk by 12%, suggesting a positive shift in the risk-reward balance. So, and then the last one was just these outcomes emphasize the importance of agility, prudent risk management, and strategic decision-making. The real takeaways from today's study are, if you want to know what the risk is in essentially event-based higher volatility, it's about of something happening when you're trading in low volatility, it's about 32%. And if you want to know what the advantage is of the higher volatility across the board, if you had nothing on, it's about 12%.
Which I think is now an easy way for me to answer people on like some sort of catastrophic event. How much is vol going to move, as opposed to just saying, it's going to move a lot? I have a number to put out there, and I think you all do too, everybody listening at home. And I think that's probably the most beneficial part of this piece. Agree?
Totally.
Let's take a quick 90-second break. You know what? We're going to your phone calls next. No Scott, so we'll go right to your phone calls. If you've got a question for Tom Sadler, give us a buzz, 855 I'm sorry, 1-855-238-2789 or 1-855-BE-TASTY. That's the number to call. I got 4 or 5 lines open. Great calls yesterday. Love to continue it strong to the end of the week, meaning today. We'll be back in 90 seconds. Let's Tasty Live.